Quant-Analyser. It is super simple. You've got to save the HTML file on your backtest. So again, when you've got a report that's done, you right click, you report, save the HTML file. That's all you need to do. That will save the data in the backtest in HTML format with a load of supporting files. All you then do is go into Quant-Analyser, you click load report, and you find that HTML file. This max drawdown is the peak to the low. This wouldn't all have happened in one day. So anyway, basically you upload them and they'll all show down here. You then select them all and you click create portfolio. That creates this portfolio, which is one I created earlier. And it tells you there's 11,406 trades. This is a longer test from January. And I was just exploring recency versus a long-term test just to see how this approach looks, because ultimately markets change, right? So it's incredibly difficult, as I've shared many times, to find one strategy that works because the market changes without running an 8-week, 10-week process. Yeah, because we're putting all our eggs into one basket and we can't afford not to be in sync with the market. However, I was curious because I thought, okay, well, if I'm running strategies that are different and diversified, then I could maybe absorb times in the market on some and leverage them times in the markets on other approaches. And that can be done in numerous ways. So I combine these back tests, and this is the data from January. And this is what we're currently working on right now in terms of POW Pass and running various different masters based with this level of detail and data like this that we've never been able to do before because the EA's obviously changed for V7. So this is really powerful shit, really, in my opinion. So upon completing that portfolio, it gives me a summary doc. And down here, I've got every single month for the year so far. So the worst month in this approach was July, where the net profit was literally 1.4%, 1396 profit. Yet the best month was September. So that was 14,206. Oh, actually, sorry, it was March, 15,000. So this gives an average monthly return of 8,700, so 8.7%. So this would literally, if you were on my Forex funds, this would have passed you on every single month to date. And this has also used the same process with in-sample and out-of-sample data, but from January the 17th until end of July for in-sample, and then forward market August and September. So clearly these 2 months here were on out-of-sample data, which still validates the predictability on that data set using them strategies, which is the key part here, right? So yeah, that gives us that, but there's more, right? So we can see list of trades. I'm not really that interested in that. Equity chart, this is what you're all sharing, which is what I love to see, because you gain a total visual understanding of how this looks. So there are flat periods. This is July mainly. It did finish an overall profit. No one was going to get rich off that. However, with most prop firms with extensions, it's at least a retry, right? But with my Forex funds, you'd have passed anyway because you'd have had next month if you'd got an extension. So there are periods of strong P&L growth, bit of a flat period here, strong growth, bit of a flat period, and then it's shut off there again. But please consider this. So before, if we chose one of these strategies and it had a losing run, that would have been -4%. If we had 2 consecutive losses, that would have been -8%. Well, now it's -2%, and you've covered that profit with other strategies. It's a massive change. It's a huge change. Like here, look, on this day, these 2 strategies lost 1% each in effect. But here it made profit, here it was flat, and here it made a bit of profit, I think. Yeah. So it was a down day, but that day would have probably been a -1% day or -2% at the very, very max. Trade analysis. Some nice looking charts there. There's another thing you can do. You can create what if scenarios. So I'm not going to do that now, but you could what if scenario this and go, okay, well, what if I didn't trade Monday or Friday? What if I avoided X or Y? You can play around with that in here, which again is a nice feature, considering you can do most of this for free. You can't do all of it because this is the paid version. So I can't remember what you've got versus what you haven't got. Now, this is also important, portfolio correlation. So if everything's in green, I think you're good to go. If you've got high correlation, basically what it's saying is you could be exposed because these accounts are trading in the same way in similar positions. Obviously, these aren't, even though they're a gold strategy because they're different session times. You could do this with hedging, averaging, RSI, or you could do different pairs. You could do 8 strategies if you want at 500 to 700 risk per strategy, like some of you have done. There is no right or wrong. So yeah, that's what the correlation part is. Monte Carlo takes all of the data on 11,406 trades, because obviously that curve has played out in a particular way because of how those trades have played out in real life. However, on a different day, they could have played out in a totally different way too. Monte Carlo takes takes them trades and basically shakes them all up to give us a Monte Carlo simulation of different results. So this has given us 100 results, and we can see on here the best case and the worst case scenario. However, what's nice is it's a steady curve up, which shows that you could get a maximum, a median, or a low range within those results. The next thing, risk of ruin, is pretty much zero because of how it's set up. And this is like a prediction. This isn't like a walk forward thing. This is very different to that, but it's a visual representation like a forward Monte Carlo. So it's taking all of this data and going, okay, well, we're probably going to get a forward projection of performance within these two ranges, which again is just nice data to have. So that's that really.